Hello and welcome back. My name is John Rosenau. I am the Vice President and Chief Operating Officer of MONECO Advisors here in Fairfield, Connecticut. Today I'm here to present a market update for the month of March and discuss what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Now that we're in April and March Madness is behind us, the first quarter of 2017 is complete. We won't have economic data for a little while, but we know that all three major indexes gained at least 4.5% during our first quarter. But most of these gains occurred in January and February, as the NASDAQ was the only one of the three indexes to increase in March. After numerous record highs in February, March saw the S&P flatten and the Dow give back 0.72%. While the markets have provided fewer record-setting headlines in March, we did pass a milestone in terms of economic recovery. The 8th anniversary of the Great Recession's lowest market day has passed. That was March 2nd, 2009, in case you didn't remember. Looking at a few data points can show just how far the economy has rebounded since 2009. First, consider unemployment. In March 2009, the unemployment rate was 8.7%, and it reached 10% by October of that year. The most recent readings for 2017 were 4.7%, less than half of the highest rate during the recession. Next, the GDP also improved during the same time. In March 2009, we learned that the economy had contracted by 6.3% in the fourth quarter of 2008, its worst decline in 26 years. Last month, we received the final fourth quarter GDP estimate, which reported an increase to 2.1%, beating growth expectations. While the recovery pace has been slower than many people would prefer, the economy has grown almost every quarter since 2009. Another sign of our continuing economic recovery is the Federal Reserve's monetary policy. The Fed raises rates in an attempt to keep the economy growing at a reasonable pace and control inflation. For a decade, between 2006 and 2016, the Fed did not raise rates a single time. In fact, they lowered rates from 5.25% to 0 in response to the 2007-2008 crisis. By March 15 of this year, the Fed announced its third interest rate increase since December 2015. It is expected that we could experience 2 or more increases this year alone. In fact, the most recent personal consumption expenditure deflator data, a key inflation measure, went beyond the Fed's desired 2% benchmark for the first time since 2012. As a result, some analysts believe we may see more than 2 interest rate hikes before this year is over. For now, anyone with credit card debt, a home equity line of credit, or other liabilities with adjustable interest rates may see an increase in their payments soon. But remember, rising interest rates indicate the economy is growing stronger. Overall, 2017 has experienced a largely positive start, and we continue to see a variety of encouraging economic data. Well, that's it for this month's market update. We hope to see you again for next month's report. Take care. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.